The Dow is falling back towards session lows after the Fed announced $500 billion in short-term bank funding, doing little, though, to calm a lot of the fear that's out there on the street. We have the index on pace for its worst one-day percentage drop since the Black Monday crash back in '87. The S&P 500 and the NASDAQ also entering bear market territory this morning, triggering a circuit breaker that halted trading for 15 minutes shortly after the opening bell. President Trump addressed the market turbulence with reporters earlier today.
You have to remember the stock market, as an example, is still much higher than when I got here. And it's taken a big hit, but it's going to all bounce back, and it's going to bounce back very big at the right time.
We also have oil, another big mover today, on track for its biggest weekly decline since 2008 amid the escalating demand concerns and then, of course, the price war between Russia and Saudi Arabia. Joining us now to discuss more about this is Yahoo Finance's Brian Cheung. And Brian, I want to focus on that announcement that we got from the Fed in the last hour. So it initially calmed some of the fear that was out there in the street, except now we're having the market headed back down towards session lows. What exactly is going on, and why isn't this doing enough to reassure skeptical investors?
Well, I'll let investors reason through why maybe the markets are continuing to sell off, although it seemed to pop up briefly on the announcement. But I want to walk through the technicalities of exactly what is in this announcement, because a lot of people were confused, rightly so, about exactly what happened. So the Federal Reserve Bank of New York announced that they would be expanding the scope of their repo operations or repurchase agreement operations. And what this is, it's the plumbing of the financial system. So when you consider that there are all these banks, all these broker dealers in the United States that have leverage positions, they cover those positions overnight, over the course of a month, by temporarily putting up collateral like treasuries and then getting cash from another counterparty. They can do that with Bank of America. They can do that with JP Morgan Chase. They can do that now directly with the Federal Reserve Bank of New York. So this is a way to get liquidity into the system if banks need to meet any sort of balance sheet needs, what have you. So the Federal Reserve was already offering this since September. You'll recall that there was that flare up in the repo markets where we saw interest rates spike out of the Fed's target range. They've been offering this for some time, but what they have not been offering it was at the scale that we're seeing today. So actually into today, they were offering overnight operations of $175 billion overnight. They now are offering a $500 billion 3-month operation and a $500 billion 1-month operation. If you total everything that they're offering, it's well over $1 trillion. And again, this is basically for funding for banks and broker dealers. This is not necessarily the same as a bailout. They have to put collateral up with the Federal Reserve. So it's a little bit different. This is mostly about the liquidity of the system. But again, the number of it is just what's so astounding in the news announcement today.
Yeah, exactly. I want to ask you, just in terms of that number, is this something that we haven't seen since maybe what was enacted back with the financial crisis in 2008?
Well, for what's worth, we hadn't even seen repo operations at all since 2008 until last September. The New York Fed did not feel the need to offer liquidity. It seemed like all the banks were doing a pretty good job at lending with one another. But there's a concern right now with the coronavirus that you have a lot of banks that are trying to play it on the sidelines, not willing to do any sort of market making, specifically in the U.S. Treasury market, where we've seen a lot of voodoo in the 10-year and 30-year and all across the maturity ranges, where it's really not working or operating as it should because liquidity could be drying up. So that's what the Federal Reserve is trying to address here. I think that's why you saw the market spike initially at first, because it was a good thing to hear from the Federal Reserve that they were going to be providing the liquidity. But I do want to point out they offer $500 billion. That doesn't mean they push $500 billion into the market. So actually the first $500 billion operation was just done, and it only took about $80 billion of contracts of the $500 billion that were offered. So again, it didn't inject $500 billion today. It only injected about $80 billion through that one single operation. But in the coming days, does that get bigger? Does that get larger? And I think why they picked such a big number is because they really wanted to message to markets, hey, this is how much firepower that we have. This is how much liquidity we are able and willing to offer to the market.
Brian, I also want to talk about what's been going on in the Treasury market. So it's a little bit interesting when we talk about, I guess, a lack of correlation. But what was interesting was the yield action that we saw yesterday compared to what we saw in equities. So if we took a look actually at the 30-year yield, it actually increased while we saw the S&P decline pretty significantly. When we take a look at that, Bank of America was out with the note just talking about why this is a little bit alarming, what this could mean for investors. Why is this something that everyone really should take notice on the street.
So more wonk stuff here, but basically the way it works is that traditionally you would tend to think that as markets sell off, Treasury yields would go up, right? Because people are running away from risk assets. They're trying to get risk-free assets like U.S. Treasuries. And when they demand those things, the yield ends up going down. Instead, we saw yield going up as we saw the vicious sell-offs in the past few business days. Now, why is that happening? No one exactly knows the specific reason why. But we do know that it could be because of liquidity drying up, right? There just aren't any other counterparties in the space to be able to allow the market to function as it usually does, which is exactly why I think you saw the New York Fed announcement today, is because banks are just playing on the sidelines. Broker-dealers are playing on the sidelines. They don't feel confident lending right now, whether or not that's because they just want to hold on to their own balance sheet, whether or not that's because they need to supply these credit drawdowns to Boeing and these other corporates that are really hunkering down for the coronavirus. Whatever the reason, we're not seeing treasuries operate as they normally are, which is why you see the liquidity operation. Something else worth watching is the Fed's next meeting is going to be next Wednesday, because the announcement today from the New York Fed also said that they intend to buy coupons as opposed to just the short-term T-bills that it was buying at $60 billion a pace each month. That is probably the first step or the next natural bridge towards a full-on QE4 in next week's meeting.
Interesting to watch, obviously. All right, Brian Cheung, thanks so much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.